Thank you very much, everyone, for coming in. And thank you, Alex, for your very kind introduction. I think it might be helpful, as this part of this talk is about FX options, to see if how many people here actually already either use FX options or are broadly familiar with them. That's a quite a healthy enough sign. But therefore, what I intend to do is to spend some time then, for the benefit of everyone, apologies for those who are already very more experienced in this, but to look at FX options, explain to you how they work, and to look at the FX risk reversals, which perhaps not everyone is totally familiar with either, and how we can use those as alternative to FX forwards and spot. And then from there, see where charting comes in terms of FX options and what guidance that will give us in terms of the underlying spot market. So, and if you can't hear me, do please raise your hand, or if you'd like to ask any questions, I'm happy to take questions as we go along. So I thought I'd start off just really looking at an example, 3-month cable, and to try and work through a case scenario as to how you might want to trade this and the various ways in which we can do this. So if we take a 3-month spot level, a spot level in cable, say 167.11, and that would give us a 3-month forward level of 167 the figure. Now again, for those who perhaps aren't too familiar with forwards, this simply represents the interest rate differential between sterling and the US dollar over a 3-month period, and therefore effectively the cost of holding a spot position for 3 months. Forwards are not necessarily an indication of where the spot market is going to go. It's simply a reflection of the cost of holding the position. So if you were to buy a cable on a 3-month basis forward, you would trade, even if the spot market is 167.11, you would be buying sterling at a rate of 167 the figure. Now with that trade, of course, being a forward contract, there is no flexibility. You have to deliver the dollars in 3 months from now, and you will receive sterling, and it will be at that rate of 167. Now if you're hedging an exposure, that can be very useful in terms of your fixed position, you can budget around that, and that's fine. But if instead you would like to be able to buy sterling at a lower level, or if you don't want to be committed to buying 167 with that flexibility, then instead you can buy an option. You can buy a call option. A call option gives you the right to buy something at a specific rate at a specific date in the future. You're not obliged to. So if 3 months from now at expiry, sterling is below 167, then you can walk away from that trade and simply go and buy your sterling in the spot market, wherever it happens to be at the time. But for that right, you pay a premium, and you pay the premium up front. And the current pricing on that was roughly just over 2 cents worth. So you'd be paying away 0.0214 in terms of cable points. And that means that for this trade to make money, you need the spot rate at expiry not just to be at 167, but it actually needs to be at 169.14 or higher. In other words, you have to allow for the fact that you paid away 214 points as well. So perhaps a little bit more expensive, certainly, than just doing the FX forward trade, but you do get this flexibility. Now, another way to express this would be to sell an option instead. And in a moment we'll flick over and we'll look at the payoff profiles. But certainly in terms of expressing a view that sterling is more likely to go higher, that's your view, then you might sell a sterling put option at 167. Now this commits you and obliges you to buy sterling at 167 at the expiry date in 3 months' time if sterling is below 167. So if sterling's at 165 in 3 months' time, you still have to buy at 167. But to compensate for that, you receive the premium up front. So you receive the 2.14 cents, which means that effectively the rate you end up buying at is at 164.86. So you allow yourself a bit of a cushion there. So we just look at this in terms of the payoff profiles, these three trades, three ways of putting this bullish trade on. The first is to say with the forward. So you're committed at 167. If at expiry spot is moving on to the right of the chart there on the top chart is closer to 175, then obviously you're going to make around 8 cents. Conversely, of course, if spot is much lower, around 159, 8 cents lower, then you're going to lose 8 cents. It's pretty straightforward. The second is with the sterling call option. So here, you have the right to buy at 167, but you're paying away 2.14 cents up front. So again, in order to make money to break even, the rate has to be above 169.14. But at least you know below 167, you will not lose any more money other than the premium you paid away. And the third one is perhaps says arguably the more aggressive trade, in that you are leaving yourself open to unlimited losses, but only a limited profit. It's a bullish trade in that you will make money so long as sterling does not fall below the break-even level of 164.86. So that's simply 167, same rate, same forward rate, but allowing the fact you receive 2.14 cents. So as a premium up front. So your true break-even is at 164.86. So there is another way, and this is kind of what I want to get onto tonight, and that is to use what's called a risk reversal. Now, I suspect that a lot of people, certainly clients who I talk to regarding foreign exchange, who might use options to some extent, a lot of them will be unfamiliar with risk reversals, how to trade them, what they represent, and certainly how they're priced, and the fact that you can use them in technical analysis. So, let's just say that rather than wanting to buy at 167, although the market is 167.11 right now, you are prepared to buy a slightly cheaper option. So you put the strike price at 170.50 for the sterling call you're going to buy. Now, call that 25 delta. Options are graded roughly according to how deep out of the money or in the money they are. So normally a 50 delta is equivalent roughly to. Yeah,
so are these calls on the forwards?
Yes, they are. Yeah, FX, good question. FX options are always priced against the forward price, not against the spot price. If you want it against the spot price, you'll find the delta be quite different. Yeah. So obviously there is against forward. But one reason for that is because this is what the alternative is. The alternative is to buy FX forward. So therefore the option is simply another way of expressing that trade. So let's say you put a slightly cheaper option at 170.50. You're going to pay less for that because buying at 170.50 in 3 months' time is not as nice as buying at 167. So you're buying a slightly reduced protection, but you're paying less for it. It's further out of the money, therefore, at the time you buy it. So we call that a 25 delta. 50 delta is more or less money. The higher delta, 75 delta, is a very deep in the money option. It's very, very expensive indeed. So you pay your premium, say 0.80% up front. But at the same time, you sell the sterling put option we looked at a minute ago as well. Again, you put this further out of the money as well. So you're not exposed if sterling were to fall immediately below the current level. Sterling has to fall quite a long way lower, 163.30, before this option begins to go against you. Now you set these two options so that the premiums net off. So the premium you pay for the call option is offset by the premium you receive for the put option you sold. So the whole structure is called zero premium. But now let's look at the profile. So now you've effectively combined the call option we looked at earlier and the put option. And you've created this profile where at expiry, if spot is anywhere in between those two, the strike price of those two options, the sterling call is at 170.50 and the sterling put you sold to 163.30. If the market is in between those two levels, then neither option is going to get exercised. There is no profit and loss. You haven't paid premium, you haven't received premium. The two premiums were netted off at the outset. So nothing's happened. You haven't traded. But if at the expiry date spot is above the higher strike, the 170.50, then you exercise the call option you bought, and you have protection above 170.50. Similarly, if spot were then below 163.30, you are fully exposed on an unlimited basis to any losses below 163.30. So that's the nature of that trade. Now, bear with me, because it's going to get a bit messy now. We're going to look at how options are priced a little bit. And I'm certainly not going to get mathematical. I'm no mathematician. I gave up maths when I was about 14 or 15 or something. And but trading options is like riding a bike. You're going to get a feel for it. I'm sure all the comments will disagree with me quite violently. Most FX options are traded over the counter. You can buy exchange traded options, but most of them are traded over the counter, which means they're customized to whatever parameters you want. The trouble with that is that how do you assess the fair value? How do you know if the price for 164 sterling put is better or worse than the price for 163 sterling put? You're going to get two different premiums. One's further out of the money, one's closer. How do you know which is the fair value? What you're looking for here is what is the most common denominator, or rather, sorry, almost the opposite of that, is the factor which differentiates those two options will be its volatility. Now, the implied volatility is a bit like chicken and egg. You work out the implied volatility from the premium. But how do you know the premium? Well, you work out the premium from the implied volatility. So where do you start? Implied volatility is essentially the way in which the market trades options. The professional interbank market and some more professional users will actually look at the price of an option in terms of its volatility, and from there they finally work out what the premium is. But what's fixed in their mind about fair value is, are they buying? You want to buy options at a low volatility, you want to sell options at a high volatility. So essentially you're trading almost like the derivative of an option, and that's how options are traded. Now, so this implied volatility comes with the benchmark feature of option pricing, and it's quoted as a percentage on an annualized basis of how far that market is anticipated as moving over the period. I think it's really hard to get your head around this at first, and particularly, what is the fair value? How can you tell how far a market's going to move over, say, the next 3 months or 12 months, whatever it is? I mean, you can certainly look at the historical volatility, you can look at the data, and you can work out how far it's moved in the past, and you might use that as a guide. But essentially, I would look at this in the same way as Alex and I were talking earlier about how Keynes looks at financial markets. And some of you may have heard this before. He's the only economist I ever quote. And that's he compared analysing financial markets to the old-fashioned newspaper competitions, where you get maybe a page of 100 faces of 100 women, and the competition wasn't about necessarily picking which of those women were the 6 most beautiful, because that would be assessing the fair value of each beautiful company. But instead, the prize went to the person who guessed who all the other readers would think are the 6 most beautiful women. Which means, in effect, what you're doing is you're trying to work out who everybody else thinks might be the 6 most beautiful women, and so on to the nth degree. Which means essentially what you're looking at there, you're analysing sentiment. And that is what, to me, technical analysis in any financial market is about. It's analysing the sentiment of everybody else who's in that marketplace, whether you can see them or not. You don't know who they are, you don't know how many there are, but together you're trying to, through the observational price patterns, we're trying to observe the sentiment and the changes of sentiment in that market. It's not about working out fair values. It's the same thing with volatility and options. You don't really need to know where fair value is. You need to know whether someone else is going to buy volatility, buy options, or they're more likely to sell them. Now, just a couple of points at the end here is that normally volatility is quoted in terms of at-the-money options. That's the benchmark. But obviously, if you're trying to buy or sell options which are away from the current forward price we looked at earlier, then you're going to look at what's called the delta, which is again how far out of the money or how far in the money is that option. And the benchmark for those is considered to be the 25 delta, and that's what I want to look at now. So let's look at cable. Sorry, my voice is almost gone now. Cable, this is the weekly chart over the last 6 years or so. And you can see from this, obviously, the substantial fall from roughly, I think it was about July 2008, and then again in October 2008, from roughly 2 down to 180, and then again finally down to around about 135. So I think that's all pretty clear. And then since then, it's more or less recovered gently, but in more of a range-bound market. Now let's look at the price of the same period of buying and selling options, the implied volatility. So this is the price at which people were trading cable options over the same period on a 3-month basis. I think you can see from this that whatever kind of analysis you like to draw in your charts, this market trends, which to me says that people are using this market. They trade this market in anticipation of what other people are going to do next. In other words, there is sentiment in this market, and it's an actively traded market. This is not simply people wanting to hedge against the move of sterling or the underlying market. People are trading options themselves as an active asset class, and they're trading it through volatility. So, of course, we'll look at the conclusions of this in a moment, but the final chart I want to show you in this section is the 25 delta risk reversal. Now, I do need to explain a little bit what it is you're looking at here, because it's not immediately obvious.
But that was quite smooth for an IV. It seemed so smooth as a chart.
The last
one, the prior one. It seems too standard, too good for an IV chart. It's a very clean IV.
It's a very clean chart. It's one of the very few. I'm not a fan of trend lines personally, but you can draw a fantastic trend line resistance from the high around 25%. It goes through about 4 points. It's unusual, very unusual. Really. Bear in mind this is on a semi-log scale, so we're on the trend line works.
Well, just like if you're getting the implied for OTC, so that's coming from a record of one particular record? Or?
No, well, I mean, this actually is my data comes from Bloomberg, so they were taking it from a variety of sources.
Right. So would it be the actual trades and postal prices?
Good question. It would be what people are posting. I'm almost certain of it, yeah. And I have to double check. We have someone with Bloomberg expert here, but my venture.
But do you find it fits?
Yeah, I mean, certainly, it's rather like any stock market. Your data source, is it what's traded on the machines, or is it what's basically banks are posting up as their levels? You have the same issues of quality of data on this as you would in any stock market pieces. But I think certainly over time you can take this as a pretty good record.
It'll be pretty accurate because it's probably sourced from places like ICAP and the actual traded broker market.
Yeah,
that's where they're getting it from.
Yeah, yeah.
And it's only fed into bank risk management systems these days. So there are people like KPMG and PwC all over the numbers as well, making sure.
Especially nowadays, yeah. That's right. More and more of that. Yeah. 25 years ago it was quite different, I'm sure. It was the Wild West then. Okay, so now this chart is, so I need to explain to you what this is. So this is 25 delta risk versus. What this is looking at is the difference. If you were to buy a 25 delta call, so we looked at earlier, that's a 170.50, the out of the money option, the upside protection. You'd be buying it at a certain implied vol. And if at the same time you're selling is a 163.30 downside sterling put, that also is 25 delta. That would have a certain implied volatility. Now, in a market of equilibrium and no bias, no sentiment, you'd expect those two implied volatility levels to be the same. I'm ignoring any market traders correctly. You'd expect the mid-price of those two volatility levels to be the same if there were no sentiment or bias in the market. In reality, what this chart shows is that you get some very strong differences between the cost of an equivalent out of the money call as opposed to equivalent out of the money put. So by equivalent, I mean like saying 25 delta. Now, the only reason that people would trade these on different volatility from the call and the put is if, well, this comes down to supply and demand. It may be sentiment. There may be other factors which we'll look at in a minute. But nevertheless, I think the sentiment does play a strong part in this, again, because of the nature of the pattern we can see in front of us. Certainly there's a lot of volatility within the volatility, but nevertheless you can see both short and intermediate trends forming in this chart. And so it perhaps takes people by surprise that technical analysis can work even in a market where you're looking at sort of almost the derivative of the derivative, and yet still you can see how people are trading on a directional basis. So essentially what this is saying at the moment is that if the latest price, and this is minus 0.5%, means that the market is pricing the charge an implied volatility for a 25 delta sterling put at 0.5% more than for the equivalent 25 delta sterling call. At extremes in 2008, 2010, it went to a 4% difference, which is absolutely enormous.
So it's not because there's more demand for puts?
Correct.
That's a skew?
Yes, absolutely. Very strong skew. And in fact, and this market has been pretty unusual for this trade back to par, where both calls and puts are traded at the same implied volatility. It happened early in 2007 and very briefly in the middle of 2009. But apart from that, this market has almost been completely skewed in favour of sterling puts, but to varying degrees. Sorry, another one. Okay. Feel free, isn't it?
I was going to say this because the implied vol is just coming off the demand. It's not really the implied vol, it's just the demand of the.
Yeah, and
it ends up getting equal to the implied vol. It's not really. It's the demand of the option.
The demand of the option, yes, but now we have to look at what does that mean in terms of what the opportunity gives you. So, I'm going to skip back and forward here. So, excuse me if I go back and forward a bit here. So we can see from here that sterling fell quite sharply in 2008 into the beginning of 2009 before gently recovering. But also at the same time, it's no surprise that when you get such a sharp fall in cable, that just the normal cost of benchmark options, the at-the-money options, shoots up dramatically. So they're up to 25%, which is a very, very high level for FX volatility. It might be different in other markets like equities, but or rates even, but in FX it's a very high volatility. But what was striking is that was how even at the beginning of the fall of the declining spot in 2008, it was the price for hedging downside was buying sterling puts against sterling calls. It was higher, it cost more to buy sterling puts than sterling calls, but it wasn't that much more at the beginning of 2008. Obviously that became more extreme. We got down to this 4% differential of buying sterling puts over sterling calls. And that again was also very extreme. But on the way back up, this is where, in a sense, the opportunity lay. When sterling then began to rally in 2009, really up until June 2009, there was still better value to hedge the upside. Rather than buying just a 3-month forward, there was better value in buying upside protection by using risk reversals than using forwards. What do I mean by better value? Well, you could just buy a sterling call and buy a sterling put, so 25 delta. If the difference in the vol, say, is 1%, you would receive that as a net premium at the time of the trade. Or you keep the premium at 0 and you simply you put in the strike of the sterling call to a better level, or move the strike of the sterling put out, which would be better for you as well. So whether you're actually adjusting the rates at which you're hedging, or whether you're simply receiving a premium up front, nevertheless, either way, by buying upside protection using risk reversals, you would put a better value trade than trading underlying forward. So let's look at cable in terms of technical analysis. Now, I'm not going to teach you how to use charts because I'm sure you're very experienced in this. I just wanted to show you the difference here between how using technical analysis on the risk reversal actually gives you an advantage over using technical analysis on the underlying spot market. It's an advantage, but it gives you a different angle, it gives you a different perspective, and hopefully it gives you an early warning against what's going to happen in the spot. So, some of you may be familiar with DeMark indicators, which are essentially a market timing indicator looking at the most likely time and level at which a trend is going to reach exhaustion. So it's a bit of a mouthful. It's a contrarian indicator, and it tries to pick tops and bottoms. But essentially, in cable, this is the monthly chart now, again over the same time period. There were a couple of signals that, at least on an interim basis, there was going to be some correction in the downtrend. So these green lines, for those who are familiar with DeMark, using these as set-up lines, would suggest that at least the sharp downward move in cable from 2008 and again in the second half of 2009 were due for at least for a correction, and that's how it happened. But nevertheless, there wasn't really a strong signal to say this is now going to go back up over a considerable period of time, over several years, and that the downtrend was definitely over. But if you were to look at the 25 delta risk reversals, you actually get a much clearer signal. Again, this chart does appear to be more volatile perhaps than the underlying spot market, but what we're getting here in 2010 is a much more significant signal in DeMark terms. It's called a sequential 13, which is suggesting that the entire down move in this risk reversal from the high of 2007 finally reached a point of natural exhaustion. It's a monthly chart. It's a monthly chart. In fact, with DeMark patterns, you tend to find that when you're looking at different time frames, quite often you won't get the same signal on what I would describe as adjacent time frames, say between the monthly, the weekly, or the weekly and the daily. But I often find that it's sort of, you skip one and you get it. So quite often the monthly and the daily, or the weekly and the 4 hour, or something like that. In fact, in this one, the monthly did coincide with the daily charts as well. So you've got very precise signals on the risk reversals, with much stronger signals that the bias was about to change than what was observable at the time in terms of the underlying spot. So, in terms of how you could use this for trading, it's clear from a couple of charts back that the major part of the recovery started in 2009, but didn't really get going to 2010 in cable. But it was the 25 delta reversal which gave you a much stronger signal using the sequential 13. That from a level, extreme level of 4%, where sterling puts are more expensive than sterling calls, that trend was at an end and about to reverse. Now, I'm not sure if you sort of alluded to this earlier, but there are several features. It's one of the aspects where risk reversals can give you an extra insight into what's going on in the underlying spot market. I did say earlier that for me, technical analysis is all about observing the sentiment in the market and working out what everybody else senses someone's going to do next. And if you think they're going to buy, you buy, regardless of whether you think the fair value is. You just want to make money. You just want to buy before someone else does. And it's true to say that therefore, we can see from the charts of both the 5-vol, the at-the-moneys, and the 25 deltas that some of that's occurring. But I think it's also fair to say that one of the reasons why it gets some substantial variance of the 25 deltas risk reversals away from what the spot's doing, why the timing is different, is if you do, you have to be aware that the exotic options market can have throw out some extraordinarily extreme mathematical exposures to banks, particularly on a short-term basis. And that in order to hedge these highly customized structures, it's always, the banks always can't afford to go into the market and cover themselves in terms of cover their positions on a directly on the same instrument, because the spreads are so wide and everyone can see them coming. So instead, what banks tend to do is to hedge these exposures where, for those familiar with gambling, you get gamblers of 7,000% on an overnight market, which means that if the underlying spot moves in like just like 10 pips, someone will have to trade on a notional, what starts off to be a very, very small notional trade, could suddenly have to trade several hundred million to hedge a movement of as little as sort of 10 to 15 pips sometimes. So you dramatically exaggerated moves in what we call the mathematical Greeks of exotic options, so binaries and those sorts of positions. So what banks tend to do is they hedge some of the Greeks of these through instruments like risk reversals. So where it's a more liquid market for risk reversals, banks will trade vast sums in these in order actually to hedge an exposure which is derived from a highly mathematically geared, so maybe a binary option trade. And it'd be very difficult to understand what's going on in the spot market, because the spot market will react to these risk reversals dramatically as well. People, if someone's trading, say, a couple hundred million of risk reversals suddenly, you'll find it's 25 delta, well, it's going to be, half of that's going to be reflected in terms of the delta in the spot market. So the spot market can move for apparently no reason at all. There may be no large customer orders going through the market, not a chart level perhaps, but what it is going on is that it's the options market is trading aggressively in the spot through deltas, through 25 risk reversals, in order to hedge, say, very highly geared mathematical risk. And it'll be on a short-term basis. But these tend to come up very frequently. And this is what can explain, perhaps sometimes, very dramatic moves in the underlying spot, which can then quickly reverse again. So I hope I've given you some insight as to how risk reversals can impact the spot market. Yeah.
This seems like a skewed arbitrage, because we are talking about an OTC market, and we are saying that that has some indication or some extremity which helps us understand trends, and there is a need for arbitrage because these extremities cannot stay there for long, and there is a need to kind of hedge against it or do arbitrage against it, and which is why we go to the exchange traded side to kind of hedge.
Yeah.
So this is this may be here today, but may not be there tomorrow.
Yes, it's very inefficient, and the way that certainly on the OTC market, in terms of the exotic options market, banks can't hedge out all of their exposures and their potential exposures, even using the risk reversal, is only a very crude hedge. And it maybe reflect their book today by selling downside risk through risk reversals. And tomorrow, they could be doing exactly the opposite. But it will have to be done on different days. It will have to reflect their exposure of their book right now on a mark-to-market basis. They cannot afford to try and see if the two net off over a period of several days. So that you can get very dramatic moves back and forth. It is a highly inefficient market. And the only thing is that if you can chart it to some extent, I think you can begin to chart, getting some message from charting risk reversals as to what the degree of exposure is in the more exotic options market and how that's going to impact on the spot. And I don't think just looking at a chart of the spot market will give you the degree of those exaggerated moves. It won't give you the degree of the exposures which banks are facing and how that might bounce back. So we saw that 4% on the risk reversal. It traded there a couple of times. Clearly, very, very good support there for sterling calls down at minus 4%. So you can chart these, and I think therefore, even allowing for the exaggerated moves in the exotic options market, even that eventually is subject to some degree of sentiment.
Yeah, I think that was this. This is I think something like power or power exchanges where they trade power data, which is also very inefficient.
Okay.
And they also use such approaches of charting to understand how they could hedge their exposure, and that is what I felt was a strange similarity between OTC in forex and OTC in power, electricity.
Oh, that's interesting. I have no idea about that market. Thanks for sharing that. Good to know. Yes.
I think the elephant in the room for retail trade is going to be spreads. And I was wondering if you could indicate what sort of spread you might expect on a $50, $25 cable option.
What's that gentleman with CMC? I would suggest quite wide. It's not about trading them. It's about being aware of them and being aware of the impact of what's going on, say, in delta risk reversals and how that might, what signals that gives you that online spot market. I'm not aware of what the spreads might be retail. Is it? Okay. I'll certainly take the word for it. Certainly take the word for it.
That's like a retail strategy.
Okay. No, but really the point of this is really to give you insights to something going on in the options market, which you may not be aware of from simply looking at spot, and to take that into account. And say, if you can chart, you get hold of the data on risk reversals to give you just an additional tool for working out the direction of the spot market. I think we've covered quite a lot of ground this evening. I do thank you very much for your patience in bearing with me about those who maybe weren't entirely in favour of options before. Hopefully a little bit more informed about it now. Thank you very much.